Market strategy. We have our panelists, Alexander Ullman, Senior Portfolio Manager at Invesco Asset Management, and also from Asia, Dariusz Kowalczyk, the Chief Investment Strategist at SJS Markets. Gentlemen, thank you very much for being with us. Dariusz, let me start with you first. Of course, markets here in Asia were a little bit spooked by what happened with earnings on Friday, but you know what? You seem to believe that factors underpinning the market rally that started in May are still pretty much intact.
Correct. The markets that have moved so much up since March this year likely to proceed north because the Fed continues to increase the liquidity provision that was a major driver of the gains. And the U.S. Central Bank is planning to purchase almost $400 billion worth more of agency debt and MBS, which means that there will be more money slushing around the global financial system. And this is favorable for equities, commodities, corporate debt, as well as emerging market assets. So maybe gains will not be as strong as they have been recently, but they will continue to be with us for the time being.
Alexander, what about you? Do you share the optimism? Do you think this market rally can continue?
Yeah, hi, Christine. Yes, overall, I'm positive, but not across the range. So I think we have seen the really strong, say, rebound recovery rally yet. But this will not continue across the range. So you will see, I think that stock picking will become much more important. You have seen extreme spreads between good performers and bad performers. So I think it's now really time for active management and also, say, regional differences. So it won't stay as easy as it was over the last weeks and months.
So how's it going to spread out, Alexander? Give us your thoughts on what's going to outperform in terms of both regions and sectors.
Yeah, I think the market will go back and continue to focus on quality, on earnings, on cash flows, on healthy growth outlooks, etc. So over the last months or so, we have seen something that people call as low quality rally, or some people even more harsh, say junk rally, where stocks really were driven by speculation, by rebound speculation. Whereas now I think it's time to really switch back to fundamentals and go to those sectors, regions and stocks that can actually offer positive cash flows, future earnings growth, even after, say, government subsidies, etc., all these programs will roll out.
Do you go along with that, Dariusz? I mean, is that something you follow? And I also wonder what happens if we get, you know, any change around in the fortunes of the dollar, and on the basis that maybe GDP growth is better than expected out of the US.
I think that the Q3 US GDP number will be a very critical event because it will show that the recovery in the world's biggest economy is proceeding faster than anticipated. Our call is that in quarter-on-quarter annualized terms, growth will be almost 5%. So on one hand, it will be positive for risky assets because earnings outlook will improve. But on the other hand, investors will start to seriously price in exit by the Fed from some of their strategies stimulating global growth. And at that point, the greenback will begin to recover. So I think that the dollar's weakness will persist for maybe another week and a half, but then the US currency is likely to rebound. And this will definitely at least slow gains in particular commodity prices, which are so sensitive to the value of the dollar. Whether it will slow gains in equities, maybe to some degree, but
I'm sorry, it totally folds into my question, so I don't mean to interrupt you, but in Barron's over the weekend says we should raise rates to 2%. So under basically your whole scenario, I would ask you, when would it be appropriate to start to raise rates here in the U.S.?
I think that the U.S. Central Bank should begin raising rates in December. I believe that the economy is strong enough for that. And even if we have some decline in equity valuations as a result, it will still be favorable because it will lower the risk of inflation. But at the same time, I'm sure that they will wait longer because they will want to err on the side of caution, and we will not see rate hikes from the Fed until the first quarter of next year.
Alexander, are you worried? Everyone brings up the 1930s scenario where everyone thought we were out of the woods and they raised rates, raised taxes, and then, boom, another leg down. Do you think it's time to really consider doing that?
Yeah, I think as was just said, it's really the expectation that the Fed and governments, etc., they want to be on the safe side, so they will keep interest rates low. They will keep stimulus packages low, rather too long than too short. So I think it is more the risk that at some times we will see inflation rather than we will see, say, interest rates rises too early. So our expectation is that people will play it safe, but then you will have some risk of inflation next year or the year after the latest.
Alexander, thanks. Alexander Ullman, Senior Portfolio Manager at Invesco Asset Management. Dariusz, thank you. Dariusz Kowalczyk, the Chief Investment Strategist at SJS Markets. Now, Reykjavik has agreed